I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Michael Hewson on the line, Chief Market Analyst at CMC Markets. Michael, how about this trading action in the last couple of days?
Yeah, good morning, Joel. Yeah, I mean, the Fed walked us all the way up to the top of the stairs, and Europe have pretty much walked us all the way back down this morning. You know, I would liken it to a dead cat bounce, except for the fact that, you know, U.S. markets seem to be a little bit more resilient than the European counterparts. But I think this is largely as a result of renewed concerns about, you know, the European economy and the fact that German trade data this morning was pretty poor. But also Italian bad loans are at record highs, and obviously Espiritu Santo once again is back in the news after filing for bankruptcy this morning.
What was that last company you mentioned?
The Bank Espiritu Santo, the Portuguese bank.
Okay.
That saga's sort of reared its ugly head again this morning. And I think it's just a reminder to markets and investors in general that the European banking system, remains, has its own difficulties, shall we say. And we've got the asset quality review from the ECB later this month, because obviously the European Central Bank is due to take over regulation of the European banking sector. So what it needs to do is find out where all the hidden nasties are.
Okay, double dose of bad news for Germany, right? Didn't we have some bad news out of them earlier in the week?
Yes, we did. I mean, we had the factory orders data for August. That was the worst since 2009. The industrial production data, worst since 2009. And now we've seen a significant drop in exports for August as well. We dropped from 5.8%, and imports dropped as well, 1.3%. So even though they're running, a significant surplus, the fact is that economic growth appears to be stalling out.
And so that kind of goes hand in hand with, the Fed speak that we had yesterday. I mean, they're not taking interest rates up anytime soon. I mean, how can they? I mean, we're one of the only economies that's growing as a part of quantitative easing. You pull the rug out from us, and what's going to happen to us and the rest of the world?
Well, this is exactly right. And you know what struck me about this particular set of minutes, Joel, was the fact that ordinarily the Fed doesn't really care that much about the global economy or what other economies are doing. But they were worried about the effect that the slowdown in Europe was actually having on the strength of the dollar, but pushing down inflationary pressures within the U.S. economy. So, and making it much more difficult for them to actually hit their inflation targets. Well, obviously, I think the market was getting slightly ahead of itself by thinking that we were going to get a rate hike anytime soon after the end of QE this month. I mean, if you compare it to, say, the Bank of England, for example, they stopped quantitative easing over here in the UK 2 years ago. So rates can stay low for quite some time after the end of asset purchases. And I think the market is slightly getting ahead of itself with respect to the potential for a rate hike. And that's certainly being reflected in bond markets over here this morning. Spanish bond yields, record lows. French bond yields, record lows. German bond yields, record lows. Portuguese bond yields, record lows. I mean, is that really a symptom of a healthy bond market when you actually look at the finances of some of these countries?
Not at all. So with all the weak German data, I mean, they kind of been dragging their heels on QE that Draghi has been proposing. My first question is do you think they're going to soften their stance? And my second question is do you think it's going to make any difference if they do QE?
First question is, no, I don't think they'll soften their stance, certainly not in the next 6 months. There's a lot of agitation in Germany at the moment at the steps that the ECB are already making, let alone any further steps that they might make. I think it's also important to note that on the 14th of August, later this month, there is going to be a ruling in the German Constitutional Court about the legality of the OMT. Now, this is the monetary outright monetary transactions. That is likely to constrain the ECB in anything that it does. And in answer to your second question, will it make any difference? Well, bond yields are already at record lows. How much lower can they go?
Okay, yeah, exactly. So what do you think? I mean, we've had some unprecedented volatility here in the market after making the new all-time high, which I'm sure you know coincided with the Alibaba IPO, right? The same day. We had a decline in the S&P futures under 1920, snapback rally off a jobs number, which if you really look deep into it, the reason that our unemployment rate is so low is that people are actually, leaving the work. They're throwing their hands up and they're leaving the workforce. And then the people that do have jobs, and some of these jobs that are being created are really lower wage jobs.
They are, and obviously that's the same problem that we're having here in the UK. Most of the new jobs that are being created are at the lower end of the pay scale, and which is why it's not basically gravitating into increased tax revenues, simply because they're not earning enough money to really generate income for the government. One of the things I did notice, though, we had a strong rally on the post jobs after the non-farm payrolls on Friday. We had another strong rally yesterday, and on both days, on the day after, we had a significant erosion of that sort of what I would call short covering rally. And this really looks to me, Joel, a little bit like a dead cat bounce in the US market, because if you can put a 50-day moving average on an S&P 500 chart, you'll see that over the past 3 or 4 months, it's acted as support and resistance in equal measure on a fairly regular basis. And that suggests to me that unless we get above 1975 or 1980 on the S&P, we're going back down again.
Wow. I mean, I don't want to put words in your mouth here, and you definitely have qualified your statement with the 50-day moving average. But, Michael, you sound bearish to me.
I am a little bit, yeah. I am. I'm certainly bearish on European markets, because I think there's only so much the European Central Bank can do. Policymakers are in a bind simply because of the fragmented nature of the way things work here in Europe. You've got Italy and France pushing in one direction, and you've got Germany pushing in the other. You've got the after effects of these sanctions against Russia, which is obviously hurting economic sentiment here in Europe. And you've got China that's on the brink of a little bit of an economic slowdown. When you put all that together, at some point, it's going to have an effect on US markets. 50% of S&P 500 earnings come from overseas. So for me, irrespective of what you think about how buoyant the US market is, at the end of the day, it still boils down to margins.
Okay, so let's say you're a long-term investor here, and you sat through the 2000 to 2010, didn't make any money, lost money, and you've just had just an incredible rally here, unprecedented rally. What should investors do?
Well, I'll be certainly taking up some downside protection right now.
And how would you do that? How would you
certainly
do
with
that?
respect to US markets, because if you actually look at the correlations between, say, for example, US markets and other markets over the world, there was a very, very positive correlation all the way and including up to round about the middle of this year. That correlation has broken down, and I'm a lot more cautious now at buying US stocks at current levels. Very, very much so. Also, the correlation between the US small caps and the blue chips has broken down as well. And again, that makes me very, very cautious. We're getting strong moves up and down in equal measure, and have been doing for the past month or so. That speaks to me as investors are very, very uncertain. They really don't know where to put their cash. And to my mind, they need to think much, much longer term. Personally, I like Apple, not for the reasons that Carl Icahn does, but for reasons that I do think it's an undervalued company. But I am still concerned at these levels that Apple's margins can only really go one way, and that's lower.
Okay. Good fundamental. Her Capital, Sheldon McIntyre, wants to get your take on Russia and the increasing cost of defending the ruble. Is there some spillover potential there?
I think there's still I think there's still an awful lot of potential for further downside in the ruble, most definitely. I mean, people say to me that that's a crowded trade, but I don't think that there's any scope at the moment for the Russian economy to get better. Certainly, I think that investing in Russia is very, very risky. At the moment, people say it's a very, very cheap market, and certainly it is if you're a very, very long-term investor and prepared to wait, I would say 5 or 10 years. But just because the market's cheap doesn't mean that it can't get cheaper. So now that we're above 40 rubles, I think the next level really is 45.
Okay, how do you, well, just going back to, like you said, caution in U.S. stocks, I mean, do you have any kind of hedges in your portfolio with puts, or do you use the S&P 500 futures as a potential hedge? Are you just not hedging but ready to go to cash and, on a moment's notice? We can obviously sell the future, the S&P future. That's a definite very, very good hedge. Obviously, you can buy the VIX because that's fairly cheap at the moment. Certainly, historically, it's very cheap. It's not quite at its all-time lows, but certainly that's one option that you can do. Or you can put a little bit of money in gold as well, because I think for all the bearishness about gold, while it's above 1180, I don't think it's really going that much farther lower. I might revise that opinion if we do drop below 1180, but while we're above that, I still think there's potential for a bit of a bounce, because I don't think interest rates are going anywhere. Yeah, I agree. So how do you handle all the stuff that affects the market, but it's really not related to the stocks and stuff? And I'll just throw out this like Ebola thing. I mean, is that something that you just look at this as a short-term worry in the market? We're going to get things under control, or is this something that kind of creeps into your mind when you're evaluating the markets?
This is just another tail risk, Joel, for me. I mean, you look at the number of geopolitical events that we've had this year alone. I'm actually surprised that the market has been as resilient as it has been. If you look at what's happening in Hong Kong, you look at what's happened in Ukraine, you look at what's happening in Syria and Iraq, obviously the unrest in Libya as well. The world's becoming a much more dangerous and unpredictable place, and obviously the Ebola scare pretty much plays into that narrative. But at some point, I would argue that central banks can only do so much. We've seen the hit to travel stocks that Ebola has had, and the fear factor is always something that comes into that. Even if there is no apparent risk in terms of a contagion in terms of Ebola, that won't necessarily feed in to what people actually say and what people actually do. People will stay at home because they're concerned about it, because it's in the headlines, even though there may be no more risk than, say, going outside and catching the flu.
Yeah, and the thing about the airline stocks too is one of their biggest expenses is crude. It's to run it, and crude.
So they should be higher, really, right?
Yeah. I mean, it's kind of opposite thinking here. Could you give us a take on the crude market?
Yeah, I mean, I think the crude market, more than anything else, is one of those markets that's probably got limited downside. I still think that we'll probably see Brent crude in particular probably test the lows of, say, two or 3 years ago, when stockpiles were at a similarly high level. But I think there's a bit of a game going on here between Saudi Arabia and OPEC. I think as we head into winter, we may find that OPEC tighten the supply chain at their November meeting in Vienna. But between here and now, I think crude prices will continue to remain soft. I think what Saudi are doing is obviously also trying to turn the screws a little bit on the US producers, because I think the price of actually getting shale out of the ground is around about $80 a barrel. So trying to turn the screws on their margins there. But overall, I don't think they can sustain crude prices between $85 and $90 a barrel for long.
Okay, and so you give your fundamental look at the U.S. markets, the European markets. You've given us your take on the Fed stance. You talked about something like the 50-day moving average. All these things. What's the number one factor that would convince you that, hey, we're gonna shrug off all this geopolitical stuff, where market is just going to continue moving on 2,000 in the S&P futures and above? Do you base it more on your the 50-day moving average and your technical analysis, or is there something else that you're using as a trigger?
For me, I mean, it's all about Europe at the moment. I think if Europe can get its act together, then we could well see a significant bounce in stock markets. But at the moment, I'm looking at a number of levels on various indexes. The DAX, I'm looking at 8,900. I think there's a potential triple top, double top reversal pattern forming there. So I think if we get a break of 8,900 on the DAX, if you actually look at a DAX chart over the course of 2014, and you scroll back 5 years, if you look at the price action since the beginning of this year, there's 4 bases at 8,900. If we break through that, then we could go lower very, very quickly indeed. And I certainly think there's scope for us to do that. If that happens, it could pull the rest of the market lower as well. 1925 on the S&P, again 1975. I think that's the range of it. If we get a break either side of that range, I think we could get a very, very strong move. So those are really the 2 indexes that I've got my eye on at the moment with respect to future direction.
Okay, all right. We've had Michael Hewson on the line. He's a chief market analyst at CMC Markets, talking about the Fed, talking about crude, gold, European markets, U.S. indexes, really covering everything for us here, Michael. I really appreciate it.
You're welcome, Joe.
Yeah, we want to get you back on again soon, okay?
Look forward to it.
Okay.